Hi all, welcome to this session. In this today's session, we are going to discuss fundamentals of balance sheet. As we know, balance sheet is a financial statement which shows the financial position of a company on a specific point of time, which is showing the total asset owned by the company, total liabilities and total equity on a specific point of time. So which determines the financial position of the company and its liquidity and solvency position. So the key learning objectives of this today's session is define the balance sheet and explain its purpose, and understand the accounting equation and its significance in the balance sheet formula. Identify the structure and format of the balance sheet and explain how business transaction impact financial position or statement of balance sheet. How each financial transaction is impacting or affecting the balance sheet. And interpret the basic balance sheet from an exam perspective. How to interpret the balance sheet. Let's move directly into topic. The balance sheet is also called statement of financial position. Provide a snapshot of company's financial position at a specific point of time. When it comes to income statement, it's showing the financial performance of a company for a period of time. But when it comes to balance sheet, it's showing the company's statement of financial position on a specific point of time or a specific date. The balance sheet date is very specific. For example, as at 31st December 2025, like this, the balance sheet normally specify a very specific date in the report. The purpose of balance sheet. The purpose of balance sheet is to show what company owns, what company owes, and what is the owner's position or owner's equity position in the company. What the company owns mean what is the total asset in the company, and what is the total liabilities in the company, and what is the total owners claiming the company, that what we call as equity. The balance sheet is help to evaluate the liquidity position, financial stability and capital structure, and financial long-term solvency position as well. The purpose of balance sheet is to show the asset of the company, liabilities and owner's equity, and also which help the financial analyst to evaluate liquidity position, financial stability, capital structure and solvency positions. The accounting equation. There is a very basic financial accounting equation, that is asset is equal to liabilities plus equity. So the in balance sheet is always showing or representing this financial equation or accounting equation, that is asset is equal to capital plus liabilities, which what it means that the total asset of the company is either contributed by the owners or either contributed by the creditors. Suppose if a company, a business take a loan for 10,000, the asset will be increased by 10,000 and the liability, the loan will be increased by 10,000. So that is what we call as double entry accounting system. That means every transaction have two effect in the accounting system. Even if one thing affected in the balance sheet, which will affect in the two, have two impact in the balance sheet as well. Maybe in the same asset side or in the liability side or equity side, and somewhere it will affect in the balance sheet in two sides or two effect are there. So with this two effect, the accounting formula is always keep same, that is total asset is equal to liabilities plus equity. Just look into this case, if the company take a loan, the cash will increase and also liability will increase. That means asset side also increase, parallelly liabilities also increase. So like this, all transactions have the same impact, that will impact in the balance sheet in the two times, or in the two double effect are there even in the balance sheet as well. So which will always keep the balance sheet same as asset is equal to, or which will always remain the balance sheet equation same as asset is equal to liabilities plus capital. Suppose if a company buy equipment for cash, what happened to total asset? This is a question. Just thinking, if a company buy the equipment for cash, that means our cash will reduce. Same time the equipment will increase. That means there is no net impact in the total asset value. That means one asset get reduced, that is cash, and one asset is going to increase. So there will be no net impact in the total asset. For structure of balance sheet, there are two common format. Account format, that is T format. Asset is showing one side and liabilities and equity showing other side. Left side will show the total asset and liabilities and equity will show in the right side. Then the report format, this is vertical format. That means first we will report the total asset by category, that is current asset and non-current asset. Then let's come to liabilities as next session, that is current and non-current. Then the owner's equity. In the US GAAP, which is normally uses report format, this format is normally using in the US GAAP, but in the IFRS allow more flexibility, so which allowing to follow the both format, the account format or report format based on the requirement. The classification overview. There are key items listed in the balance sheet, that is assets or liabilities. Even in the asset, there are two categories are there, current asset and non-current asset. Current asset means those assets which can be converted into cash within 1 year, and non-current asset means what we call as long-term asset, which cannot be converted into cash within 1 year or within one operating cycle. This is current or non-current, or what we can as short-term asset or long-term asset. Same like this classification in liabilities as well, current liabilities and non-current liabilities. Current liabilities are those liabilities which are to be payable within 1 year, and long-term liabilities are payable after 1 year. This is a common classification in both asset and liabilities, current and non-current. Current means it is short term, non-current means it is long term. Now we are moving how the transaction affect in the balance sheet, how a single transaction is going to affect in the balance sheet. Suppose owners invest cash. This is a financial transaction, so which will increase the total asset of the company and total liability also. Liability and equity side also. That means in this case it is equity. So the take a loan. Suppose a company take a loan which will increase the asset, cash will increase, and the liability, loan is a liability which also increase. Then buy inventory for cash. Buy inventory for cash means your cash is reduced and the inventory, the other side inventory is got increased. There will be no net impact in the asset side. One item get reduced and by one item get increased. Then company earns a profit. Asset is got increased and the equity also going to increase. Then company pay an expense by cash. Asset is going to reduce and the equity also going to reduce. So this is how each transaction affecting in the double entry effect. That means either it is in the same category or in a different category. Just look into this case. A business start with owner investment is 50,000 and loan taken 20,000 and buy equipment 30,000 for cash. So in the initial transaction, that is mean owners contributed 50,000, asset will increase 50,000 and equity also get increased 50,000. Then step 2, loan taken, asset. In this case, if you take 20,000 loan, asset will increase to 70,000, that means 50,000 plus 20,000, and the liabilities, total liabilities will increase to also 20,000. That means total it will be liability and equity side will be 50 plus 20. That means also 70. The liabilities and equity side also 70. Both will be remain 70. Then if the company purchase equipment by cash, that means cash will reduce 30,000 and the equipment, the asset side will increase 30,000. Again the same asset remains 70,000 as previous same scenario, because the cash is one category of asset which is reducing and the equipment is another category of asset which is increasing. So with this transaction, the final financial position will be cash. We will end up with 40,000, equipment 30,000. So the total asset will be 70,000, and the liabilities are known as equity. Loan will be 20,000, and the equity will be 50,000. The total liabilities and equity will be 70,000. So in this case, you can see that total asset is always matching with the total liabilities and equity. So let's move into practice question, multiple choice questions. Question 1. Which statement best describes the balance sheet? Option 1. Show performance over a period. Option B. Show financial position at a point in time. Option C. Show only cash flows. Option D. Show only probability. This is option B is the right answer. Show financial position at a point of time. Balance sheet is showing a financial position of a company on a specific point of time. Question 2. A company purchase inventory for cash. What is the impact? Asset increased, asset decreased, no changes in total asset, liabilities increased. So in this case, the answer is option C. That means there is no changes in the total asset. That means inventory increasing and cash is decreasing. So when we are looking into total net asset, there is no changes in the total net asset. Question 3. If a company has asset 200,000, liabilities 120,000, and if the company earned a profit of 30,000, what is the new equity? After considering this profit, what is the new equity? So what we have to do, we have to calculate the current equity here. Total equity is in this case 200 minus 120,000. That is 80,000 is the total equity at this position. And if we earn a profit, it will automatically we have to add with the current equity, that is 80,000 30, that is 110,000. Just a short answer question. Why must the accounting equation always balance? The answer, every transaction has dual effect under double entry accounting system, ensuring total resources equal the total claim also. Total resources mean the total asset is always equal to total liabilities and equity. Before winding up this discussion, just to have a quick summary. So the balance sheet is showing the financial position of a company on a specific point of time. The core financial balance sheet equation is asset is equal to liabilities plus equity. That means the total asset or total resources has equal total claim also. Either it is liabilities or equity. There are two structures are there. Asset, either it is showing on the left side or in the top side, and the liabilities and equity, either it is showing on the right side or in the bottom side. Then every transaction maintain the balance in the balance sheet or in the statement of financial position, either whether it is in the same category or one impact in asset or another impact also in asset, or one impact in the asset, another impact in the balance sheet, or in the equities, or anyway it is always maintaining a transaction balance in the balance sheet. The balance sheet is directly linked to income statement via retained earnings. The retained earnings section in the balance sheet, it is directly coming from the income statement. This is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.